everyone. Thank you for joining us today. Welcome to the PPP Loan Forgiveness, the Final Act webinar. We are glad to have you with us, and we're going to dive right into this. I'd like to take a quick minute to introduce our speakers today. We have Erica Horn, who's an Associate Director of Tax Services and has more than 30 years of professional experience. She has spent the majority of her career advising clients on state and local tax issues. Through her advice and advocacy, Erica has saved her clients millions of dollars in taxes. Erica has experience in a wide range of industries and is a prolific speaker and author. John Wurtenberger also joins us, a Director of Assurance Services who has more than 10 years of experience providing audit and consulting services to clients of various sizes and industries. John began his public accounting career at PricewaterhouseCoopers and has served as the lead audit director on exclusive public and private companies with multiple locations and international operations. He focuses his practice on consulting and advising clients on audit and accounting matters. With that, I'll turn things over to Erica to get us started today.
Good morning. Welcome to perhaps the final act regarding PPP loans, forgiveness. I say perhaps the final act because, as all of you know, this program has been so up and down, mostly down, I would say, that it's hard to know if this is the final word or if there will be more. So for that, we'll have to wait and see. This morning, we're going to spend very little time on the beginning. Can you believe that tomorrow, 9 weeks ago tomorrow, will be when the CARES Act was passed? Loan applications could be submitted 8 weeks ago tomorrow, and here we are now with everything we've been through talking about forgiveness. We're going to look specifically at the loan forgiveness application and its constituent parts, and then we're going to talk briefly about SBA loan review. So yes, as I said, it was 9/8 short weeks ago that we all got on this journey, the PPP loan journey, we could call it. We started out wondering about things like what constitutes payroll costs and how do we calculate that, and what do some of these other things mean, and we struggled through that, and we learned that oftentimes after we no longer needed the answers to our questions got answered. So hopefully this time, while this forgiveness guidance was late, in my estimation, hopefully it is not too late. Really briefly, the Paycheck Protection Program, the PPP, is part of the CARES Act signed by President Trump on March 27th. The program is in that CARES Act. It's about 880 some odd pages. It's in Section 1102. That is made part of the Small Business Administration Business Loan Program. It is a Section 7A loan, so the rules of Section 7A of the Small Business Act apply unless they've been specifically overridden by something in the CARES Act. Loan forgiveness is provided for in Section 1106. And then we have the program being jointly administered by the Small Business Administration and Treasury, the United States Department of the Treasury. Those are actually independent. Well, actually, I don't know. The Small Business Administration might be within the United States Department of Treasury, but in any event, those are executive branch agencies executing the law that Congress, our legislative branch, has passed. There has not yet been any involvement by the judiciary, but who knows? That may be yet to come, so that we can have all branches of our government in there. I think it's fair to say that the Department of the Treasury has been the big dog, that SBA has kind of been the tail wagging in the background, as I think all of the difficult decisions or controversial decisions have been made by Treasury and then pushed down through the SBA. You'll hear us perhaps talk about SBA or Treasury. Those terms, as far as I'm concerned, John, are interchangeable. So if you hear us and you're confused, just consider those two things the same. I've got two slides. I've got this slide that's called authoritative guidance, and the next slide is called non-authoritative guidance. So authoritative guidance in law world includes the United States Constitution or a state constitution, statutes, and regulations. So the statute at issue here is the CARES Act, again, Sections 1102 and 1106. The regulations, we're used to the Internal Revenue Service calling them regulations. SBA calls them or they call them rules. Right now they're called interim final rules because none of them, the first ones may now be final, but they started out as interim. So we've had 15 now interim final rules. The first one came out after the first set of loan applications were submitted and provide general information and some examples. The third one came out after small business, self-employed, and other individuals were able to apply on April 10th. It gives really good guidance in the sense that very specific guidance for folks who file as Schedule C. The 14th and 15th IFRs came out, as John will show you, on Friday night. 14 talks about loan forgiveness and 15 talks about loan review. You can see all of these at Treasury's website. Treasury's website has been superior to SBA's website, has been updated more frequently. It's a little easier to navigate, I think. So there is that website. It's on this slide and the next slide too. In terms of non-authoritative guidance, what does that mean? Well, it's something that is not a constitution, a statute, or a regulation. It's designed to help us understand better. So in this category today, we have frequently asked questions. There are 48 of them now. Loan forgiveness application itself, and how to calculate loan amounts, which is just a separate document in the borrowers section of the Treasury website you see down there below. Provides good information when it comes to partnerships, K1, S Corps, K1s, people who get something other than a Form 1040 Schedule C. And it's odd, I think, at this point that hasn't been put into an IFR or incorporated into an IFR some way. The loan forgiveness application has been IFR 14, mirrors the application. John and I were talking about it yesterday. We haven't seen any specific inconsistencies. You all may prove us to the contrary. It might not be. There might be some inconsistencies, and we just haven't run across them yet. If guidance is non-authoritative, I should just ignore it. True or false? If it's non-authoritative, I should just ignore it. So you shouldn't just ignore it. There's valuable information in there, but you should be aware that all parties, meaning both the government and the borrower, can use this non-authoritative guidance as a sword and as a shield. So I might want to use it as a shield because you said, that's right, false. Because Treasury said that this is how I calculate payroll costs. It's in FAQ something or another. I used to know, and Treasury says, well, we've changed our mind. And you're like, wait a minute, this is what you told us. And so the problem with non-authoritative guidance is the government can change its mind, and it's a little harder to hold them to the wall when that happens. And then they put all of that information about whether or not you have faithfully or in good faith signed the certifications in frequently asked questions. And so there are going to be times when they want to use that themselves as a sword. And likewise, that same stuff can probably be used as a shield. To the extent that this non-authoritative guidance goes beyond the statute or the rules, the interim final rules, the rules once they become final, it's not. It is of little value. Let's not say no value, but of little value, because you cannot, an administrative agency cannot go beyond the statute in technical terms. So, John, I am going to stop there, and I am going to let you talk about forgiveness, IFR 14, and the application.
Thanks, Erica, for providing that foundation and background that I think is helpful as we kind of talk through the forgiveness and the new guidance that was released. So as Erica mentioned, you know, I like to think about, and Erica, if you could flip over to the next slide, I like to think about, you know, be careful what you ask for in this situation. There were weeks leading up to this where we said, okay, we know there's guidance, there needs to be guidance released. There's questions that are unanswered. We need some clarity, and everybody was just waiting. And little did we know that we would start to get a trend of this new guidance being released late on Friday night, which unfortunately makes all of our weekends very fun and enjoyable as we get to digest some of that guidance and understand exactly how it applies, so that we can get you know, the publications and schedule these webinars out to our clients and to the public. But it's unfortunate that it's on Friday night and it's not, you know, during the work week. But essentially, as Erica alluded to, on the 15th of May, they came out with the loan forgiveness application, and that was kind of the first glimpse that we got into the guidance and some of the unanswered questions that were out there prior to there being a lot of clarity around the forgiveness. And so with that loan forgiveness application came some definitions, you know, examples of really how to calculate the reductions, which we'll walk through later on, and provided some clarity into some of the questions that were lingering out there. So, and with that application, they also alluded to subsequent guidance shortly being released, and that was shortly within a week. And so that following week, on the 22nd, that next Friday, they released IFR 14 and IFR 15, and that was late Friday, 11 p.m. or so, but it was consistent with what we had heard earlier in the week from the AICPA webcast that said that they were going to try to get new guidance out, you know, within the next 48 hours before the weekend. So IFR 14, as Erica mentioned, talks about loan forgiveness, and our IFR 15 talks about the loan review procedures and provides some clarity and some detail into what that will look like, as well as some borrower and lender responsibilities, which we'll cover all these in greater detail. So we'll go over to the next slide and talk about the loan forgiveness application to start. So few components of the loan application. One, there's that calculation form itself. To supplement that calculation form that actually walks you through, okay, what are your total payroll costs, and ends with, here's your loan forgiveness amount. There's a Schedule A, and then an accompanying Schedule A worksheet. And what that Schedule A worksheet and Schedule A does is that actually helps you walk through those FTE reductions, those salary and wage reductions that will then feed into the loan forgiveness calculation form. Along with the calculation form and the Schedule A worksheet and Schedule A itself, there's more clarity on documentation requirements. So what documentation needs to be submitted along with the loan application, and what documentation just simply needs to be retained by the borrower for a certain period of time. And then they tacked on a demographic information form, which is optional at the discretion of the borrower to fill out and submit. They specifically made it clear in the application that filling it out or not filling it out should have no determination of what your forgiveness amount is when submitting the application. So of those 5 items in the application itself, only items 1 and 2 are required to be submitted to the lender when applying for forgiveness. And I think that's a key point just to reemphasize. You know, the application is going to be submitted to the lender, not to the SBA, to your lender, and then your lender is going to make the decision for the forgiveness from there. So let's flip over to the next slide here, and we'll talk a little bit about the key terms that existed in the application, and then also some clarity that we received through the guidance that was released with it. So payroll costs and non-payroll costs. Really, not a lot had changed between the definition of payroll costs and non-payroll costs from what it was in those initial interim final rulings and somewhat in the CARES Act itself, and between what was actually released in the application. So not a lot of changes. They did come out and clarify, gave some examples about when salary and wages were paid versus when they were incurred. So from a paid perspective, the date that paychecks were distributed to employees or the borrower originates the ACH credit transaction. That is when salary and wages are considered paid. Incurred is simply when the salary and wage was earned by the employee through working on a particular day. And then non-payroll costs, as I mentioned, again, no big changes here. You still have your covered rent, your covered mortgage interest, and your covered utilities. They did add a little bit of language, and Erica, I don't know if you think it's helpful or not, on the utilities piece around, a distribution or a service for the distribution of water, gas, electricity, transportation. I think that provides a little clarity into some of the questions that people had around, hey, is my business, car or fuel, eligible for forgiveness? But I don't know that it specifically answered the question. Yeah. Erica, do you have thoughts there?
It just confused me, frankly, because it says the distribution of gas. Well, anyway, time is limited.
Right.
We didn't find it helpful.
We should keep moving so we can get through this.
I'll leave it at that. We can
address some of those with the Q&A. Yeah. And then one of the big things that everybody was hoping that the application would address is paid or incurred, or paid and incurred. What does that mean? And can we get some clarity into that? And so they did provide some answers to the application, which we'll go over on the next slide. But essentially, they provided this on the back end of your covered period. If you incur cost, that can be payroll or non-payroll cost, through the end date of your covered period or this alternative payroll covered period that we'll go over here in just a minute, you can pay those subsequent to the covered period or the alternative covered period end date on your next regular payment date or payroll cycle, and it'd still be eligible for forgiveness. So a lot of people initially were thinking, okay, do I need to implement a special payroll, that's going to be paid out right at the end of my 8-week period in order for it to be forgiven so that the cash actually went out the door? They specifically said no need to do that. You continue paying it just like you normally would, and then you can just count that towards your forgiveness. So we'll flip over to the next slide here and talk about, what this covered period and this alternative payroll covered period means and what that looks like.
Hey,
so
John.
The covered period, sorry, were you going to say something, Erica?
When you talk about this, will you please explain to me how to count to 56?
Yes.
I've had significant difficulty counting to 56.
Yes, and I think you would think it'd be relatively easy, right? But honestly, getting that 56 days in can be a little bit tricky when you talk about your start date and your end date. So the covered period really has always been in existence since the CARES Act. That's the 8-week period beginning on the date of your loan disbursement, and that is still consistent. And that's an option for a borrower as it relates to payroll costs. So keep in mind that the covered period is going to be your period for non-payroll costs. That's non-negotiable. There's no other option for that. Your non-payroll cost covered period is the 8-week period beginning on the date of your loan disbursement. For payroll costs specifically, there is now an alternative payroll covered period, which we use the acronym APCP throughout the slide deck. And that is the 8-week period starting on the beginning date of the first payroll subsequent to your loan disbursement. So essentially you would say, my loan was disbursed on April 20th, so you could elect the covered period for both your non-payroll and payroll costs, which would be the 8-week period beginning on your loan disbursement. Or you could elect this alternative payroll covered period, which is simply just for payroll costs, which would start after your loan was disbursed, and it would be triggered by that first date of your first payroll following your loan disbursement date. So let me give you an example really quick. So you have loan proceeds that were disbursed by a lender to the borrower on April 20th, 2020. The first day of the first pay period following the loan disbursement is April 26th. The covered period that you would use for non-payroll costs and potentially payroll costs if you elected to do so would start on April 20th, 2020, and that would be day one. So when you're counting to 56, you need to count that as day one. If you just pull up a calendar and you say April 20th and you go, okay, 7 days, 7 days, 7 days, 7 days, you're actually going to end up including one extra day on the back end of that. So if you look at April 20th as being your first day and you count April 21st being your second day and you count out the 56, your end day to spend those loan proceeds in order to be eligible for forgiveness is going to be June 14th, 2020. If you elect the alternative payroll covered period for your payroll costs only, your start date would be April 26th, 2020, and your end date would then be June 20th, 2020. Does that make sense a little bit, Erica, you think?
Yeah, I think the key, one of the places I kept getting hung up is doing exactly what you said, 7777. And
right.
The key is that first day has to count. And then I've struggled with the APCP. So in your example, after my origination of my loan, the disbursement date, the April 20th, the first pay period after that date where earnings started for my employees was April 26th, right?
That's right. That's right.
Okay. So then that becomes my alternative payroll covered period if I choose that. And then do all of my payroll costs, not only my salary and wages, but also my employer contribution to health insurance and retirement plans, they have to go within this same April 26th to June 20th period too, right?
That's right. That's correct, because that is all kind of wrapped into that collective definition of payroll cost. Okay. And so payroll costs would follow either the covered period or the alternative payroll covered period, whichever one you elected.
Okay. All right. Dates,
all right,
John?
So some key dates, and there's a lot of dates. There are a lot of dates to keep in mind, and we'll walk through this in more detail later on and provide some examples of what the FTE calculation looks like, as well as the salary and wage reduction looks like. So these are just some key dates to keep in mind, but remember, there's a lot on this slide. We'll go over that in more detail later on in this slide deck. So for FTEs, for full-time equivalents, some of these are consistent with what was previously in the IFRs. One of them is a little bit new, and I'll highlight that. So the reduction quotient, when you are actually calculating your FTE reduction, is going to be your FTEs that were calculated for the covered period or the alternative payroll covered period. So you have that election for this FTE calculation. You need to be consistent, obviously, with whatever you elect for the payroll cost. You can't say I'm going to elect the covered period for my payroll costs, and then I'm going to do the alternative payroll covered period for my FTE calculation. You need to be consistent between the two. But as you think about this reduction percentage that's calculated, it's going to be that FTE that exists during the covered period or the alternative payroll covered period over the historical reference period. And we'll give some examples of that later on. So for the historical reference period, the borrowers have the choice here of choosing between what historical reference period they want to calculate their FTEs for and what's going to be the denominator in that equation. If you are a non-seasonal borrower, you have the option of choosing between February 15th and June 30th, 2019, or January 1 through February 29th, 2020. If you are a seasonal employer, you can choose between both of those options that I just listed, either the 2019 or the 2020 option, or they added in a new 12 consecutive weeks between May 1st through September 15th, 2019. So previously, they said that if you're a seasonal employer, you basically have to take the 2019 option, which was the February 15th through June 30th of the two above. But now you have the option of choosing both those two, either 2019 or 2020, or a consecutive 12-week period between May 1st and September 15th, 2019. And again, that's only for seasonal employers. And then when you think about the safe harbor relevant dates and the safe harbor exemption that exists for FTEs, which again we'll cover here later on, there's a few key dates that you just want to be mindful of here. you're going to need to calculate your FTEs for a few different periods. One of those is going to be your pay period that includes February 15th, 2020. You're going to need to calculate your FTEs for the time period between February 15th and April 26th, 2020, and then as of June 30th, 2020. So there were a lot of dates here and more dates here, unfortunately, for salaries and wages. I'm sure your head is swimming with the amount of dates and ranges, and really could it be more? But hopefully the slides later on in the examples help clear things up for you. But flipping over from FTEs, the other reduction in calculation that borrowers are going to have to do relates to employee salaries and wages. And so when you're trying to calculate any reduction that might stem from employee salaries and wages, you're going to need to keep in mind and calculate the salary and wages during the covered period or the alternative payroll covered period. So again, that's at the election of the borrower, but need to be consistent with what you elected for payroll costs and FTEs. And then also the previous guidance and the IFRs and the CARES Act mentioned this first full quarter that the employee, previous to the loan. And so they came out in the application and defined exactly what that is. And that was what I think most people were expecting it to be, which was the first full quarter of 2020 calendar year, which is January 1 through March 31st, 2020. So you need to calculate salary and wages for employees during those periods. And then again, there's a safe harbor exemption that's available for salary and wage reductions. And those dates are consistent with the FTEs. You need to calculate your salary and wages as of February 15th. And so I guess the only difference as I'm talking through this is salary and wages is going to be as of February 15th versus the pay period including February 15th when I think about FTEs. And then you're going to calculate salary and wages for February 15th through April 26th for employees, as well as the average salary and wage rate during or as of June 30th, 2020.
Yeah, so like John said, he'll come back to that because he has examples of how to get through those calculations. So talking about the application itself, we said at the beginning that it has 5 parts. It has a calculation form, it has a Schedule A worksheet, a couple pages on documentation, and then the optional demographic information. You really have to start at the back with the worksheet for Schedule A, and you ultimately bring all that forward. And so whereas no different, I suppose, John, really, than, of course, this is not your bailiwick, but preparing a tax return, you have to prepare the supporting schedules before you can really do the first and second pages. The calculation form, or that first page, it's really not the first page, it's the third page of the application. The first 2 pages are instructions. Summarizes is where you summarize all your information, your name, your FEIN, how much loan you received, the SBA loan number, all those sorts of things, and where you begin to summarize the amount that you're seeking for forgiveness. So no surprises in these first 4 lines, and you can see that the whole application is very specific in terms of telling you where to pull the information from. I do think on this particular slide, it talks about business rent or lease payments. The instructions to the form, which are consistent with the 14th IFR, say for real or personal property. So we had a question throughout about whether or not they really meant lease payments on personal property. And whereas I don't think that's what Congress really meant, that is what Treasury/SBA really means. And that is a game changer for some businesses. Of course, again, you have to stay at that 75% threshold right now for payroll costs, so that will put some limits on those numbers. Business utility payments, we still have that question that has been raised as a result of the 3rd IFR about self-employed individuals, where they suggest that gas for a car would be okay. Is fuel for our trucks or our fleet or our cars okay? I mean, ladies and gentlemen, that's a judgment call. I don't think so. I do not believe that was remotely what was intended. Payments made and costs incurred is the standard, like John said, and he'll show you in a minute how that language is used, how it's activated. Here on the form is where you have your adjustments for any reduction in salary and wages or FTEs that is not restored. If those reductions are restored, then there is no reduction in your loan forgiveness amount. And those safe harbors that John are talking about is how you determine whether or not those items have been restored. Here is this must be my favorite section of all. Although I'm quite fond of tables 1 and 2 of the worksheet, John. But you start with, here, again, you're still pulling from the back. But notice the heading here, potential forgiveness amounts, potential forgiveness amounts. Line 8 is basically your total forgivable cost adjusted for the salary and wage reduction or the FTE reduction. Line 9 is your loan amount, which was the great promise, right? That all or almost all of your loan would be forgiven. And there are a number of issues with that great promise now, not the least of which is what's on line 10, which is this 75% requirement. I really cannot explain to you how they came about this approach, John, to getting the 75% calculated. Let me just say that the end effect is that your non-payroll costs are reduced in proportion so that it is 75% of payroll costs are 75% of your total forgivable cost. You enter the smallest of lines 8, 9, and 10, and there, ladies and gentlemen, is your forgiveness amount. Not to be sacrilegious or anything, but frankly, I feel like doing the sign of the cross when and if I get to that line item, because it will have been such a labor to that point. So speaking of the worksheet, John, here you go.
Yeah, we can talk about the worksheet and the uses, and maybe before we get into that, let's touch on quickly, Erica, about that whole paid versus incurred concept, so that people, understand exactly what the guidance was that came out. So, if you're reading through the application and the subsequent 14th IFR, the guidance that came out really talked about being able to pay and count towards forgiveness payroll costs that were incurred, payroll costs and non-payroll costs that were incurred prior to the start of the 8-week period, but paid once you received your loan proceeds and that 8-week period started. And what they've come out and said essentially is that those costs are forgivable, and that if you incurred payroll costs before your 8-week period began, but you paid those payroll costs out during your 8-week period or on the beginning of your 8-week period, then those count towards your forgiveness, similar to non-payroll costs. So if you look at the 14th IFR, there's an example in there about utility payments, and it talks about your 8-week period starting on June 1st. That's when the borrower received their loan proceeds. But it talked about their payment of their May utility bill being on June 1st. Does that count? And the answer is yes, that counts towards your forgiveness. And then on the back end, they've talked about those costs incurred up until the end date of your 8-week period, and then paid out in the subsequent billing cycle. So it seems to me, Erica, and if I'm just simplifying this, that you're able to pull in previous amounts incurred on the front end of your 8-week period, but on the back end, you have to cut that off at the end of the 8 weeks. Is that correct?
Yeah, and I think that I was going to ask you the exact same question. I went back to the slide where we have the covered period and alternative payroll covered period example. I think that's really odd. So if I understand correctly, and John, help me out, let's just deal with the covered period because it really doesn't matter. So April 20th is my start date, and on the 25th, I pay my utility bill, and that was for utility service rendered in March. So because I paid it in April, after the 20th, after my start date, then it counts as a covered utility cost, right?
Right.
And then on the other end, on June 14th is my end date. On June 25th, I pay my my utility bill just to be consistent for May. On July 25th, I pay my utility bill for June, but I have to prorate that utility bill so that it only includes June 1st through June 14th. Is that your understanding?
That's correct. That's consistent with the example that they put into the 14th IFR.
That's easy. Easy peasy. That's that's the name of this whole program. Easy peasy.
And that is similar to payroll costs as well.
Yes, payroll costs works the same way. I'm there. Okay. Here you go.
I'm sure there will be some questions on that, but sure. We can answer those later on. So Schedule A worksheet, the uses. We've talked a little bit about what Schedule A, the information that is included within Schedule A, but you're going to use Schedule A to identify your compensation for your employees, your average full-time equivalents for the covered period or alternative payroll covered period, whichever you elect. And then also your salary and wage reductions. And you're going to calculate both the salary wage reduction and the FTE reduction using Schedule A. And then you're also going to utilize Schedule A to determine your qualification as to whether or not you meet the safe harbor exemptions that exist for both FTEs and salary and wages for employees. And what is a safe harbor exemption, right? It's simply if you qualify for a safe harbor exemption, it eliminates any potential reduction to your forgiveness amount that would have resulted from reducing your FTEs or reducing salary and wages for employees between, the covered period or a historical reference period, essentially, is to boil it down. So let's walk through this a little bit more in detail for both the FTEs and the salary and wages. So we'll start with the FTEs. So when you're thinking about, okay, I keep hearing this term FTEs, I know I need to calculate something. What do I need to do? Well, essentially, to boil it down, there's three procedures. You're going to calculate your FTEs to start. You're going to determine whether or not you meet the safe harbor qualification. And then if you don't meet the safe harbor qualification, then you go on and you calculate what your reduction would look like for FTEs. So let's talk a little bit more in detail about what that means. So prior to the release of the application and the subsequent IFRs, everybody was speculating on what the definition of an FTE would be. Some people took the approach, okay, maybe it means 30 hours or more. That was consistent with, I think, what the IRS considers to be a full-time equivalent. The application came out and defined an FTE as an employee who works 40 hours or more on average each week. So rather than 30, it ended up being 40.
And in the IFR, John, Treasury says, we chose 40 even though you all had talked about 30 because we believe most employers use 40. I wish I had made that a polling question. In your experience, which standard do most employers use, 30, 32, or 40? I just thought it was funny that they acknowledged that everybody had been saying 30, and then they chose 40.
They did. That's exactly right. Hey, at least they can hear us. I guess
that's true.
That's a positive. I don't know.
Everybody
was seeing whether or not they could even hear us with all of our questions. So the acknowledgement is good. So in the application itself, it also offered two different methods to calculate your FTEs. So it offered this detailed method, which if you just think about it and think about calculating the 40 hours or more and boiling that down to an FTE amount, it's probably the approach that most people would take if they didn't offer this simplified method. So the detailed method is simply, let me calculate my hours paid per week for my employee. So if that was 40, I'm going to take 40 and I'm going to divide it by 40 and I'm going to get to 1. If my hours paid per week for an employee was 20 and I'm going to divide by 40, I'm going to get to 0.5. And you're supposed to round to the nearest tenth there. Under the simplified approach, they basically said, okay, if you have anybody that's working less than 40 hours a week on average, you're going to count them as 0.5. So somebody who's working or paid 38 hours a week is going to be a 0.5. Somebody who's working or paid 10 hours a week is going to be a 0.5. But anybody who's working on average 40 hours or more, you're going to cap that at 1, essentially. And that goes to the next point, that no individual employee can exceed 1. So you can't have an employee who's working 60 and count them as a 1.5 to offset somebody who's working 20 who's calculated as a 0.5, essentially. So each employee is capped at 1 full-time equivalent, and you can choose between using the detailed or simplified method. That's at the discretion of the borrower. You just need to be consistent between the different periods that you're going to be calculating the FTEs for using the detailed or simplified method. So one of the other things that came out in the application as well was excluding employees who refused to return to work if they were formally offered a job back, were fired for cause, voluntarily resigned, or voluntarily requested a schedule reduction. So again, this was one of the questions that a lot of people had on the front end was, what if I have people who just don't want to come back to work? You know, they're sitting at home, they're making more money on unemployment, and they don't want to come back. Or what if I had somebody who was going to retire and ended up retiring, or somebody who left voluntarily, or I had to fire for performance issues? Am I really going to get dinged for that on my FTE calculation? Well, they came out specifically and they said no, that you need to make sure that you're adding those reductions back when calculating the FTEs.
Hey, John, they
Yep.
did kind of give employers an out on the refuse to return because we are making more on unemployment. If you have that situation where you've had employees who refuse to return, whether it was for that reason or because they were going to take another opportunity or pursue a different job, whatever it is, one of the requirements is that you put that offer to the employee in writing. They have to be offered the same position they had before at the same rate for the same number of hours, and also that you report the refusal to the unemployment office. And golly, Moses, I meant to put the Kentucky and Indiana email or forms in here, and I completely forgot. But when Jenny sends the follow-up email, I'll include those links to those forms to make that easy to do.
Yeah, and we'll get into a little bit of that in the documentation section. So, all right, so the first, as we talked about, you're going to calculate your FTEs, then you're going to determine whether or not you're going to qualify for the FTE safe harbor. So this exemption essentially has 2 criteria in it. It's 1, did you have a reduction in FTEs between February 15th and April 26th? If that answer is yes, then you've met the first criteria. If you didn't have a reduction in FTEs during that time period, you're not going to meet the safe harbor. So you might as well just stop there. So if that's a yes, if you had a reduction between February 15th and April 26th as compared to February 15th, then you move on and you say, was my reduction eliminated on or before June 30th, 2020? And if so, then you meet the qualifications for the safe harbor exemption. If 1 and 2 are met and you meet the exemption, there's really no need to go ahead and calculate what any potential reduction would be, because that reduction is going to be fully eliminated by qualifying for the exemption. However, if it's not met, then you're going to move on and calculate what the FTE reduction amount would look like. And let's give some examples. And I'll start going a little bit faster here because I want to leave some time for questions at the end. But here's how you would go about calculating the FTE reduction, and we've talked a little bit about this already when we looked at what that equation might look like, with the covered period number being on the top and the historical reference period being on the bottom. But you're going to need to calculate your FTEs for either the covered period or the alternative payroll covered period. And then you choose that historical reference period that we covered earlier when talking about key dates for FTEs. And that's either, the period in 2019 or 2020 for non-seasonal borrowers. And then there's that third option for seasonal employers only, which is that consecutive 12-week period between May 1st and September 15th, 2019. You're going to divide A by B, and then you're going to carry that line, that amount, that quotient to Schedule A, line 13. All right, so moving on to the salary and wage reduction. Again, kind of three procedures here to calculate what that reduction is going to look like for you specifically. One, you're going to determine if an employee, if their salary, wages, their pay was reduced greater than 25%. If it was reduced greater than 25%, then you move on to determine whether or not the safe harbor was met. And then if it's not met, then you're going to calculate what that reduction actually was. If the pay wasn't reduced less than 25 or greater than 25%, then there's no need to calculate any sort of reduction because it's only focused on if the pay was reduced greater than 25%. And we'll go walk through some examples here in just a minute of this so that becomes a little bit more clear. A couple things just to keep in mind when we're thinking about the salary and wage reduction. Only include employees who were either new in 2020 or in 2019, employees that did not receive an annualized equivalent of $100,000 during any single pay period. So the standard and the guidance basically talks about excluding those employees that, received $100K annualized during any pay period in 2019. Those employees that were new in 2020, obviously you're going to include those because they didn't receive any pay in 2019. So that's why specifically that's in there. You're going to need a couple pieces of information to calculate this. You're going to need your average annual salary or hourly wage during the covered period or the alternative covered period, whichever you elect. And then you're also going to need that average salary or hourly wage during that first full quarter that was mentioned, which ended up being January 1 through March 31st, 2020. One thing that did come out in the application, the subsequent IFR, is that there's no salary or wage reduction related to a decline in hours. So if somebody was making $25 an hour during the first full quarter, made $25 an hour during the 8-week period, but their hours were reduced from 40 to 20, there's not going to be a reduction for that employee from a salary and wage perspective because there's going to be a corresponding reduction for that employee in the FTE calculation. So they didn't want to have to basically hit people twice with a potential reduction for both salary, wages, and hours. So they said there's not going to be a salary and wage reduction in that specific situation. And that will actually be example number 4 as we go into some of these examples here, Erica. So example 1, forgivable costs during the 8-week covered period is going to be consistent throughout. That's just a reference point, but that's going to be $180,000. For this particular employee, they started off in 2020 during the first quarter making $52,000 a year. Boil it down to $1,000 a week essentially. During the 8-week covered period, the employer said, "Hey, we can't pay you 52. We're gonna have to cut that by 50%. Your new annual salary is going to be $26,000 or $500 a week." So what would the reduction be here to the forgivable cost as a result in the decline in the employee's salary? The answer is $2,000. The salary reduction for that employee went from $52,000 to $26,000. 50% reduction, so that's greater than 25%. So you're going to move on and you're going to calculate what that reduction would be. And then that forgivable cost reduction is going to be that $2,000, which you can see the equation down there below. It's essentially saying, I was at $1,000. I could have paid them 75% of $1,000 and not had a reduction, which would be that 25% threshold. That would be $750. You're going to take $750 less what they actually made a week during the 8-week period, $500, and you're going to multiply that by 8 weeks. That gets you to $2,000. So this is also assuming, I know we talked about meeting that safe harbor exemption and then going on and calculating your reduction. These examples are assuming that you didn't meet that safe harbor exemption. And that safe harbor exemption is simply, did you restore that salary or wage for that employee on or before June 30th? So in this example, if they said, okay, $52,000 was your first full quarter salary, we're going to reduce you down to 26, but we're going to bring you back up to 52 on or before June 30th, there would be no reduction for that specific employee in this example. So just keep that in mind as we walk through some of these. Example number 2. So we have an employee who, again, started off the year making $52,000 a year, annual salary. Rather than cutting that down to 50% of $26,000, they reduced their pay slightly to $44,200. What's the reduction in this scenario? The answer is 0. The salary reduction was 20% rather than 50% in this example, less than a 25% reduction. So there's no reduction to the forgiveness amount for this particular employee. So again, just keep in mind that's reemphasizing that 25% threshold. So moving on to example 3 here for an hourly individual. So an employee who's making $25 an hour, that correlates to $1,000 a week if they're working 40 hours a week. During the 8-week period, they cut their pay. They said, you're making $25, we have to reduce it down to $17.50 an hour. That translates to $700 a week if they continue working 40 hours a week during that 8-week covered period. What's the reduction in this scenario? The answer is $400, and it's really calculated similarly to how we calculated the salary reduction in example 1, where you take kind of what they were making weekly and during the first full quarter, $1,000, you multiply it by that 75% to get what you could pay them without having to calculate a reduction. That's $750. Then you subtract that by what they were making a week during the 8-week cover period, $700, and you multiply that by 8 weeks. And so if we're moving through this too fast, remember, I think these slides are going to be sent out later on, so you can always reference them later on subsequent to this, but we do want to allow for some Q&A on the back end. So the last example I kind of already covered with you as I was talking through that there's no decline really for a decline or no reduction in the decline of employee hours worked. So in this example, again, the pay remained consistent for an hourly employee between the first full quarter and the 8-week covered period at $25 an hour. However, they said you were working full-time, 40 hours a week, but we're just not open or we're not operating at full capacity for our business, so really we can only have you work 20 hours a week. Well, because of that reduction in hours, there's not going to be any salary and wage reduction because that $25 an hour remained consistent. That reduction is going to be picked up in the FTE reduction for that employee, which if you calculate the FTEs in the first full quarter would be 1. If you calculate it during the 8-week cover period, it would be 0.5.
So John, do I have to do, I don't know how to do this unless I do it for every employee. Is that what I have to do?
Yeah. Unfortunately, yes. You have to do it for every employee. So the salary and wage reduction lends itself to coming to that conclusion a little bit easier than the FTE calculation does. Somebody could look at that FTE calculation and say, I'm just going to look at my total hours paid for all my employees, divide by 40 for a given period, and that's going to be my FTE number. The problem with that is when you get into that cap at each individual employee for 1 of an FTE. So you might have, if you just aggregate all the total hours, you might have an employee that's working or paid for 60 hours versus somebody who's working and paid for 20 hours. And if you're not capping each individual employee at 1, you're going to get to a different conclusion if you're looking at that in the aggregate versus looking at it employee by employee.
And this loan program was available for employers with up to 500 employees. It's a good thing we have Excel. That's all I know.
Lots of calculations are needed.
So we're going to breeze through these next several slides because they're just a recitation of what you will find on the worksheet and on the Schedule A. Schedule A has 4 parts. You bring forward the worksheet Table 1 totals, the worksheet Table 2 totals. Let me just pause here on cash compensation. It's defined as salary, wages, commissions. They don't say tips, but it would include tips, amounts paid to furloughed employees, so W-2 wages, gross W-2 wages. Employer contributions to employee health insurance, employee retirement plans, employer state. The language of the act and the regulation or the rules is and local unemployment taxes. So perhaps there are some states where there are local unemployment taxes as well, and that's why it reads that way. Compensation to owners. So owners are separated from the rest of the population, and in the IFR 14, and then in the application here, is the first time we see a difference between owner employees and other owners. So that is interesting. We have internally known that there is a difference. That in the S corporation context, in particular, you will have owner employees, and so the language around that is of interest and of note, and you should look at those instructions. Part 4, then you take your total payroll cost, and you're going to take your FTE reduction calculation that John just talked about and apply that. And here you see that application. Documentation. So there's been a lot of talk, and really they didn't veer very far off the written page in terms of what documentation you should expect to have to include. They do make a distinction between documentation that you have to send with your application for forgiveness and documentation that you must simply retain. And you must retain all of it, what you send plus the other stuff, for 6 years. So 6 years, yes, 6 years. Here are the items that you must submit. I was thinking about this yesterday too. I think I would put together a pretty little loan forgiveness package for my lender to try to make things just as easy as possible, because think about the number of these loan forgiveness applications that your lender is going to receive. And while I'm sure they will incur a large amount of overtime, anything you can do to help streamline the review process will likely garner you some favor. And garnering favor is always a good thing. Third-party payroll documents, bank statements, Form 941s, state employment filings, health insurance statements, retirement benefit statements. We've talked about the non-payroll costs before. FTE support. Now, how in the world they think that a Form 941 and or a state unemployment filing, well, okay, I'll take it back. State unemployment filing, maybe. If they can tell anything about FTEs from a Form 941, then they are better, smarter people than I am, which there are many. I'm not saying. I say that about unemployment because most, if not all of you, know that you individually list the employees on those forms. Here are the things you must retain: support for your calculation of individual employee salary and wage reductions. They already talked about the FTE reductions, why you excluded certain employees. This would be documentation related to the employee job offers and refusals, the terminations, the voluntary reductions. You want to keep everything that remotely touches on these calculations. And that includes, we've had these discussions previous, but all the reasons why you applied for the loan the first time, that should be in your file, as well as you should continue to document all the reasons that you find going forward that it was a good thing that you applied for the loan. So in the 15th IFR, they set forth some loan review procedures. And one of the first things that they say is a loan of any size may be reviewed at any time. Well, I could have sworn, John, that they came out and said that they weren't going to look at loans under $2 million. Did I miss something?
They said it wasn't going to trigger an automatic review. I think they've always left that little inkling and ability for them to go in and review any loan if they wanted to, but it wasn't clear. It was buried.
Yeah, some people will be surprised. And specifically, they're going to look at those certifications, which is not listed on here, that's a whole separate piece of wax. But they're going to look at whether or not the loan amount was correctly calculated, whether the proceeds were used for allowable purposes, very important, and whether or not the forgiveness amount is based on the application. That is the literal language of the IFR. I don't know what that means. Got any thoughts on that? I mean, the whole application. I don't know if that means correctly calculate your FTEs. I don't know what that means.
Yeah.
So if it turns out that you were ineligible for the program in the first instance, forgiveness will be denied and the loan must be repaid. The SBA may also pursue other remedies. Other departments of government, such as the Department of Justice, may investigate these loans for fraud. So it's not only the SBA. And then I think this is really important, and I have colleagues that I hope are on the webinar because we've talked about this sometime. You will be judged based on the rules and guidance available at the time that you made your loan application. So one of the best examples of this is with self-employed individuals. So self-employed individuals applied, a lot of them, before the third IFR, where it came out and included, among other revelations, that you were going to be limited to 8/52 of net earnings on line 31 of the 2019 Form 1040 Schedule C. And that healthcare, that meant that healthcare insurance premiums paid for the owner would not be included in the forgivable amount. If you did your application before that guidance came out and you included those health care costs in your calculation, then my argument is that you are entitled to have those costs as forgivable costs because you didn't have that guidance at the time of the loan application. I know we've said throughout this program, check with your lender. I was buoyed by the idea that they actually put borrower will be judged based on rules and guidance available at the time of the loan application in the IFR itself. What is the lender going to do when they get your loan forgiveness application? They're going to make sure that you initialed by all of the borrower certifications. And we haven't talked about those today, but those are very important, and they should be paid attention to and signed only after having fully understood them. They're going to make sure that you have included the documents that are necessary to review payroll and non-payroll costs. They are going to confirm calculations for compensation. And I really think, I hope that what that means is just ticking in time, making sure that they can find the amounts in the documentation that you have provided. And then confirm that you correctly calculated the 75/25 limitation. I would suggest that any failure to do so is a failure of the form itself and not any particular individual, as they have made that difficult. The lender will issue a decision about forgiveness. They can approve the forgiveness application in whole or in part. They can deny it. They can deny it, quote unquote, without prejudice pending review by the SBA. That means that you would get an opportunity as the borrower to object to the denial. I can't imagine that in that second bullet, the deny, where it doesn't say anything and implies that would be with prejudice, meaning you couldn't ask for an explanation or try to make things better or whatever. As John mentioned early on, you submit to the lender submits to the SBA the forgiveness calculation form, Schedule A, and the demographic information if provided. And I know I'm flying, but I really want to get to your questions. Here's the biggie. I don't know when the borrower is going to find out if the amount was forgiven. 60 days after receipt of a completed application, the lender has to submit the application to SBA. SBA has 90 days to review and remit the forgiveness amount to the lender. Is the lender going to wait until they get the money from SBA to let the borrower know? I mean, at this point in time, we are right up to, if not past, the date on which the payment deferral ends. So remember, the payments are deferred for 6 months, roughly 180 days. And we're 150 days in here, and we're going to pretend there aren't any delays. Am I going to have to start making payments on my loan for the full loan amount while I am cash starved? The other unanswered question is, when in the world how long do I have to make my application? Clearly, I can't make my application before June 30th because I've got to figure out whether or not I'm going to be able to meet the safe harbors. And if they want the most recent 941, well, I don't file that until July 31st, so I guess the banks are going to get a bunch of loan forgiveness applications August 1st. Hopefully, although I'm almost tired of saying this, guys and gals, hopefully they'll give us a little more color around that. John, do you want to talk about et cetera, as the king said?
Yes, I can, and I apologize. I think I might have lost my video connection, but I'll try to get back up there as soon as I can. But what we know now, we covered the paid and or incurred item earlier. That was the question that everybody had around what payments to include in the covered period. What's the definition of FTEs? We covered that as being employees that works 40 hours equal a full FTE. The 75-25% limitation, we covered that briefly. It came out that 75% of the forgiveness amount should be spent on payroll costs. I'll get to that in a second here on a subsequent slide. And then also, I think Erica mentioned it early on, but in that 14th IFR, they specifically came out and said that bonuses and hazard pay are considered forgivable payroll costs, but are still subject to that $100,000 annualized cap for employees during the covered period. So if you're going to give employees bonuses or hazard pay and you're going to seek forgiveness for that, just make sure that you're mindful of that $100,000 annualized cap per employee during the covered period. All right, so this slide, quite honestly, needs a little updating based upon some technical corrections that came out to the proposed bill late last night, and we will do so when we send out the updated slide. But there is currently a House bill referred to as the Paycheck Protection Program Flexibility Act of 2020 that is awaiting House vote and is expected this week. What does this do? If it's passed by the House, then goes on to the Senate, passed by the Senate, and signed into the law, and it remains consistent with the wording that exists right now, what's it going to do? Well, it's proposing to extend the minimum loan term from 2 years to 5 years. It is proposing to replace that June 30th, 2020 date that we talked about in relation to hiring employees back and eliminating an FTE reduction or eliminating the salary and wage reduction, replacing that date with December 31st, 2020. And then it's also increasing the 8-week covered period, or proposing to increase the 8-week covered period to 24 weeks. And I checked on this right before the webcast, and it looked like, as I mentioned, they pushed through some technical corrections. And what it looks like now actually is that it's going, that 8-week period going from 8 weeks to 24 weeks is the earlier of 24 weeks or December 31st, 2020. So they're recognizing that there's still some proceeds out there that are yet to be applied for from borrowers, and borrowers maybe haven't started their 8-week covered period quite yet. And so if your 24 weeks, if this gets passed, would extend beyond December 31st, 2020, then it would cut off on December 31st, 2020. A couple other key changes really quick, just to mention, just so that people are aware. It's okay, it's fine. Is in the updates that went through last night, they are also proposing to change that 75%, 25% rule to be 60% on payroll costs and 40% on non-payroll costs. So that is another addition that wasn't in there previously that just got added last night. And then the other thing that Erica actually just touched on regarding to coming up on the deferral period for people on payments and interest, they are also proposing to extend that deferral period for payments of principal and interest on these loans to not begin until the forgiveness amount and decision has been made and remitted to the lender. So that gives people an extension to wait during that period where they're supposed to submit their application to the lender. SBA may review it, and then once they approve that application and they submit the forgiveness proceeds to the lender, that's when the deferral period would end.
Okay, hurry, John.
Yeah, okay, so maximize your forgiveness. Use proceeds for forgivable costs. Choose your covered period wisely. Choose for payroll costs. Choose whether it's going to be the covered period or the alternative payroll covered period, depending on where your pay periods landed and when they were paid, as well as the FTEs during each period. One could be more advantageous than the other. 75% of the forgiveness amount for now should be spent on payroll costs. Restore your reduction in FTEs and employee salary wages on or before June 30th, and retain and submit documentation. And some of those things are subject to change, as we mentioned, based upon the House bill that's currently up for vote right now.
So to add to what John said, on Friday night, the Senate tried to pass a bill extending the covered period 16 weeks. The House proposal is 24 weeks. They're working on it. Thank you, John, Jenny, and thanks to all of you for joining us today.
Thanks, everyone. Appreciate it.